My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you a little bit of money. My job is not just to entertain, but to educate, to try to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Call it the firmament. Not Wall Street, but the firmament. That's where Scott Besson, the Treasury Secretary designate, comes from. So the fence sitters and skeptics are jumping on the Trump bandwagon as if the president-elect said higher stock prices and lower taxes for all. And that's how you get today's action, with the Dow gaining 440 points. This is to an all-time high. The S&P advancing 0.3% and the Nasdaq edging up 0.27%. Now, we know there was going to be a quick burst of buying, not when Donald Trump won, but when Kamala Harris lost, because despite the fact that the stock market did incredibly well under her boss, Joe Biden, their administration was seen as a wild, soak-the-rich White House. Didn't matter that Harris tried to be more pro-business in her campaign. Didn't matter that her brother-in-law, a huge campaign advisor, was the general counsel of Uber. When you're a former senator from California, one of the most progressive states in the nation, Wall Street's not going to believe you're a friend of capital, a fancy word for the moneyed interests. This is no longer the Bill Clinton era for the Democratic Party. When I met with Clinton back then, he was fascinated by the market. He had some genuine knowledge, but even more important, he had intense thirst for how it worked. These days, the Democratic Party at best has no thoughts about the stock market. I often think that the words stock and market, when put together, become an ugly epithet not worth uttering. On the other hand, President-elect Trump was all about Nielsen ratings when he was on The Apprentice. And as president, he repeatedly said the Dow Jones Industrial Average, all-time high, and the S&P 500 were his new Nielsen ratings. He likes being rated. He likes to win. He wants that stock market to go up to ratify his performance. That's a big reason why the market exploded higher when he won. But soon after the election, we heard that the euphoria was over. You heard that, right? You heard the whole thing. The market was dead. Because while Wall Street loves a Republican trifecta, it doesn't love Trump's tariff proposals. Tariffs are basically a selective sales tax that only applies to imports, and the countries that get hit with them tend to retaliate. Very unpopular on Wall Street. Now, enter Scott Besson. He is a consensus candidate, very different from the kind of guy we thought could get the job. A measured former hedge fund manager who formerly worked for George Soros, of all people. Besson's he's a pure surprise. He's the kind of pick you make if you're trying to be as reasonable and responsible as possible. Part of the modern firmament that stands for the money classes, but also those who aspire to be a part of them. What does Besson give you besides a good pedigree and sop to those who want things to be somewhat normal? Well, he brings the 333 policy. That's borrowed from former Japanese Prime Minister Shinzo Abe, someone who's been revered for putting the sullen Japanese economy on firm footing back in 2010. It was called the Three Arrows plan back there. 3 arrows, 333. How does it work? We have an out-of-control budget deficit in this country. Something that should give us pause. $1.8 trillion alone in this fiscal year that ended in September. That's insane, but not nearly as insane as the $36 trillion in national debt that we have run up with no obvious way to pay it down. Anyone who tried to put pen to paper during the Trump campaign figured that he'd take the already busted budget and bust it even worse, if that was possible. I know that the progressive wing of the Democratic Party, in their postmortem, disliked Vice President Harris's how she presented herself as the saner person when it came to the budget. Because why? Goldman Sachs said she was. Goldman's the most liberal of the investment houses, but in certain circles it's regarded as a bastion of right-wing rapacious potters, like from It's a Wonderful Life. Trump, on the other hand, couldn't be bothered with anything involving the budget except to have our allies and enemies pay it down with tariffs. Even if that argument was absurd on the face of it, he doesn't care. Trump's the self-described king of debt. But Besson, well, his plan to cut the deficit to 3% of gross domestic product by 2028, well, it makes sense. It's prudent, frugal even. And it shows that Trump must be taking this stuff seriously or he wouldn't give this guy the job. Now, there's two ways to make the national debt manageable. You can inflate your way out of it, Weimar style. Weimar, bad. Or you can grow your way out of it. That's where the second part of the 3 arrows comes in. 3% GDP growth, helped along by deregulation. It's a Goldilocks story. Not too much inflation, not too much deflation, and enough growth that we can gradually shrink the deficit without having to implement draconian spending cuts. Are there really that many restrictive regulations that make it so that things are slow in this country? Okay, Goldilocks, it was a fairy tale. But there's a theory that says the financial system has been held back for ages by federal regulations that impede growth. Now, in reality, it's mostly state and local regulations that impede growth. But there's plenty that could be rolled back at the federal level. I say that as a small business owner, serial small business creator, not a journalist or whatever the hell people think I do for a living. Finally, the third of three arrows produce an additional 3 million barrels of oil a day. Now, this one's a pipeline dream. I thought of that myself. First, I don't know if it's really possible, even if you opened up every acre of federal land, which you won't be able to because there are laws protecting that land. The most you could add right now is probably about 1 million barrels a day. You need all sorts of new technology to get beyond that. Plus, the oil industry would hate it. The price of crude would fall through the floor if we added that much production because there's not that much demand. That would lead to a self-fulfilling set of cutbacks that would then send the oil back probably to where it is now. That's a round trip. It does nothing for anybody. So you might say I'm a skeptic about all of the threes. I do, however, like that Besson also held out that he doesn't favor jamming on huge tariffs all at once. A phased rolling is much more my style. It's certainly his, too. Can there be a legit top-to-bottom line change in the efficiency of our government and the costs associated with it? Count me as a skeptic about any attempt to change the government, including Elon Musk and Vivek Ramaswamy's Doge thing, because every penny of spending in the budget has a constituency. And when you add all those proposed cutbacks together, you run into a tremendous amount of opposition. But that's not the point. What matters is that this Treasury Secretary designate is a serious person, not unlike Steve Mnuchin before him. And those who believe Trump couldn't get a dollop of rigor in the cabinet, well, they've been proven wrong. Don't take my word for it. Take the bond market's word for it. We were all fretting about the 10-year going to 4.5% just a few days ago, and now we're cheering about a 4.28% yield as rates have plunged in the announcement of Besson getting the job. There really isn't anything else. You may regard this as splitting hairs, but when you're dealing with credit, which is the largest market on earth, you see these numbers and you think happy days are indeed here again. What a switch from just a week ago. I'd like to say that every basis point counts, and there are hundreds of basis points. But when rates go low, housing gets revived, car loans get extended, the parts of the economy that are ailing can recover. Bottom line, that's what's being celebrated today, all from one nomination. Then again, for Wall Street and for the firmament of moneyed interest sometimes, it's really all that matters. Hey, why don't we go to Matthew in Massachusetts? Matthew.
Hey, it's Matthew's mom. Here's Matthew.
All right, let me hear him.
Hey, Jim. Thanks for taking my call.
Absolutely, Chief. What's up?
I was wondering, how do you think Trump's stern stance on tariffs and his goal for more balanced foreign trade policy will affect overseas companies such as Alibaba?
Well, I've got Matthew, who's also going to be my co-host, and then he's going to take over the show Friday when I'm on vacation. And Matthew's already got game. He's wealthy. You know, I don't think that Trump can necessarily hurt anybody over there. I will say this: if he did get higher tariffs, then Alibaba stock would go down. But Matthew, why don't you handle that in what we call the B block on Friday? Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course. What's up, Jerry?
Jim, this beaten-down rental car giant is staging a comeback, and I'm glad to see some of my losses are finally being erased. Over the last 3 weeks, it's up over 50% on no news. This morning, I sold an eighth of my position when it soared 16% from the open. Was I premature to start liquidating my position in Hertz?
No, you weren't. This is what you have to do. I am in favor of speculation. What you have to do when you speculate is that when you have wins, you have to take some off. Again, I'm not against speculation. I am not a scold. 95% of the people on TV would hate the fact that you're even a long Hertz. Not me. I think it's great that you're in Hertz. But as long as you get a profit and take some of it, then you're fine. Otherwise, yes, I too would join the nation of scolds. When rates go down, parts of the economy that were ailing can recover. Sometimes that's all it takes to push the Dow to another record high, including a appointment of someone that no one ever heard of 2 weeks ago. Oh, man, I am running through a three-part series about signs of excess from across the tape, like we just discussed with our friend Jerry in Missouri. Now, I've got to tell you one thing, though. I'm also going to be diving into AI and software names with a big run-up, and you better write them down because I want some profits taking in some of these, but that's up to you. If you're up big, you need to take something off the table. Where do the fintech, alternative energy, and China-based companies come in this market? Well, I'm doing the same thing with those. And then later on, a closer look at some red-hot Trump trades after the GOP's election sweep. And again, I want you to do what I told Jerry to do, or what he was doing by himself, which is take some profits so they won't go away. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last couple of weeks, we've seen signs of excess bubbling all over the stock market in all sorts of places. To the point where I feel like devoting the whole show tonight to laying them all out for you so you're prepared, be ready. All in all, I think it's perfectly reasonable for the S&P 500 to be up 4.9% for the month of November, given that we got a Republican sweep on Election Day with promises of lower taxes and deregulation, something Wall Street always adores. Plus, we got a rate cut from the Fed a few days later. The Magnificent Seven haven't gone crazy either. They've actually been pretty tame this month. So if it's not in the averages or the Mag 7, where's all of the excess that I'm talking about? Frankly, it's everywhere. It's all over the place. We'll have a remarkable rally for one-off stocks one day, then something similar in another stock the next day. You can see it on the crawl at the bottom of the screen every session, quickly after the bell and very early in the morning. Gains in names you never heard of. And that's why this week, during the weekend, what we did was this. We ran a simple screen looking for U.S.-listed stocks that are large enough to talk about on air, with total returns of more than 50%, 50, for the month of November. As of the close last Friday, there were 66 darn stocks that fit that bill, which is an insane number. 66 stocks with takeover-sized gains. Well, but people are really making money, provided they are also taking something off the table. No money made until something off the table. When you dig in this list, what you find are several baskets of stocks that people can't stop buying. They just can't keep their hands off them. And some of these are actually a lot less legitimate than others. So let's start with the unprofitable quantum computing plays, because the best performer of November, at least so far, is a company called Quantum Computing. That's QUBT for all you home gamers. It's up an astounding 588%. That's closely followed by two more quantum plays, D-Wave Quantum and IonQ, both of which have more than doubled month to date. That last one sounds like a TV station I'm not working for. Honestly, I have no idea what's behind the sudden interest in these quantum computing stocks. Don't ask me to explain the concept either. You need a physics degree to get your head around it, and trust me when I say that most of the buyers do not have one. While people have been talking about it for years, it's still highly experimental. But I do know stocks, and when you look at the history of QUBT, do you know that this was a beverage company until 2018 when it pivoted to being in software for quantum computing. Now, that failed to inspire much interest, so in 2022, QUBT acquired QPhoton, which is a developer of quantum photonic systems. Right now, they're building a semiconductor plant in Arizona to make specialized materials for quantum computing. And the stock seems to be running on the fact that they're on track to open this facility in the first quarter of next year. And this month, they announced the first few orders for their planned Arizona fab. Again, I have no edge in quantum computing, but I do know that QUBT is losing money and has hardly any revenue. Through the first 9 months of the year, it only racked up $311,000 in sales. This is 6 years into the quantum computing pivot, people. Somehow QUBT is a $910 million company. Excess of D-Wave Quantum came public via a SPAC a couple of years ago, always reassuring. And it's also unprofitable. But at least it's on track to make about $9 million in revenue this year. Is that enough to justify a $647 million market cap? The last one, IonQ, is surprisingly an almost $7 billion company after more than doubling this month. They're unprofitable, too, though IonQ is expected to reach $41 million in revenues this year, up about 88% from 2023. I like that. No disrespect to these three companies, but I think people were just reaching for anything with the name quantum in it. Quantum this, quantum that. That seems to be a theme across all the pockets of excess that we're going to discuss. Which brings me to the next group, anything with AI in the name. And that starts with AI Unlimited Group. That's up 349% in the month of November. Then there's SoundHound AI, up 60%. Big Bear AI up 42%. C3 AI up 54%. That AI Unlimited Group company was previously known as Lever Global until the name changed in July. It hardly had any trading volume before this month when the company completed 3 acquisitions in the fintech and travel industries. But for now, just know this. AI Unlimited is one of the hottest stocks in the market despite having no revenue, no earnings. What can you do? The other stocks with AI in the name are a little bit more legitimate in that they all have revenues, even if they're unprofitable. Take C3 AI. They're on the show a lot, right? We've had them on the show. The analysts are expecting $382 million in revenue for 2024, up 23% year over year, even as the losses have also steadily grown. Now, this thing came public in late 2020, and there's never been much interest in the stocks until a few weeks ago. The only catalyst I can find is that they announced a strategic alliance with Microsoft last week, which sent the stock up more than 24% in a single session. The stock's now trading at nearly 13 times sales, which is absurd for a company with only 23% revenue growth. Again, excessive. The rampant speculation anything with AI in its name has also bled into the enterprise software space. So take Ino Data, okay, which is actually on our homework list right now. The company describes itself as a, quote, global data engineering company. Yeah, and it has AI all over its website. Ino Data is actually profitable, and it touts relationships with magnificent 7 customers, but multiple short sellers have targeted the company this year, including one who alleges that Mag 7 relationships are vastly overstated. The stock's up huge after Ino Data reported a huge top and bottom line beat earlier this month. The darn thing spiked more than 75% in a single day. Even though the company also disclosed that it's received subpoenas from the SEC and Justice in the third quarter. They say it's related to conduct alleged in a shareholder lawsuit. Personally, I'm not going to pay up for a stock that's being subpoenaed by both the SEC and the Justice Department. To me, I'm calling that fraud. A bunch of other enterprise software plays have shot up more than 50% for November, like Bill Holdings and Palantir Technologies. Those are more justifiable. But both companies are turned to profit. Both reported strong numbers earlier in the month. But Bill Holdings sells for 52 times this year's earnings expectation, while Palantir trades at 170 times earnings. I love Palantir. I'm calling it a tad excessive. I could go on. There's Applied Optoelectronics with a 143% return in November. They make optical equipment for the data center. There's Canaan, up nearly 80%, which is focused on, quote, high-performance computing, chip design, chip research, and development computing equipment production and software services, end quote. And that's kind of everything, right? Then Geometry, which rallied almost 66%. It calls itself a, quote, leading global AI-powered manufacturing marketplace, end quote. Faro Technologies, up 53%, describes itself as a leader in 3D measurement, imaging, and realization solutions. AvePoint, AVE, Point, at a, quote, is a global leader in data security, governance, and resilience, end quote. It's up 50%. And Indie Semiconductor makes semiconductors, photonics, and software platforms, end quote, for autonomous driving. It's up more than 63% in November. 5 of those 6 companies I just mentioned are unprofitable. The lone exception is Faro, F-A-R-O. That's another one that's been around for ages, but investors only started caring about it past month. Bottom line, all right, we're seeing signs of excess all over the place, people, especially in tech. And it's making me a tad nervous, if only because some of these stocks simply have good names and almost nothing else. If it was just tech, well, believe me, I could handle it. But the excess is everywhere. So stick around after the break, and I'll walk you through some more of them. Mad Money's back after the break.
Coming up, not sure if it's the right time to get into the market? Cramer's taking you on a trip down memory lane and letting history be his guide on when to buy stocks. Next.
Like I told you before the break, we're seeing areas of speculative excess all over this market. Getting maybe a little nervous. Quantum computing, anything with AI in its name, some parts of the enterprise software space, they've all had absurd gains this month. Frankly, they're just the tip of the iceberg. This dynamic goes way beyond traditional tech stocks. Take the consumer financial technology space, or fintech. Robinhood, Upstart Holdings, Affirm Holdings, these are all up around 60% for November. SoFi's rallied more than 40%. Those are all high profile. There are also some winners I've never heard of. Dave, I was making fun of David Faber. He hates the name Dave, okay? But you don't call him Dave, but I'll call Dave Dave. That is a digital banking app. It's up 121%. How about Sezzle? No, not Sizzle. Sezzle, a buy now, pay later challenger, has run 116%. Moneyline, which calls itself a top consumer finance super app, it's about 102%. Now, these moves are tough to definitively call bubbles. Robinhood, Upstart, and Affirm all reported better than expected, or at least better than feared quarters. I think there's some truth to the idea that fintech will get a lighter regulatory environment under Trump. That makes sense, doesn't it? While Affirm and Upstart are losing money, they're both expected to begin making money starting next year. And Robinhood's solidly profitable right now. In fact, even Dave, Sezzle, and Moneyline are expected to turn a profit this year. Lightly used. The only problem is their stocks have gotten very, very expensive. Robinhood trades at 52 times earnings. Sezzle's at 42 times earnings. Moneyline's at 46 times earnings. I don't know if these valuations are justifiable. Maybe their earnings are going to just have a huge renaissance. But it's certainly, let's just say these are a heck of a lot higher than they were in October. And maybe that's pause. Okay? That's pause concern. Beyond fintech, there's been huge rallies in anything with a tech suffix. Insurtech, meaning insurance companies with some sort of tech kicker. That's word just gigantically. Lemonade, up 115%. Root uses tech and data science to offer better car insurance rates. It's up nearly 60%. Hippo Holdings, they love these animal names these days, is tech-enabled home insurance with a nearly 50% gain for November. I think these moves are totally excessive because all three companies are deeply unprofitable. Lemonade's on track to lose more than $3 per share this year, for heaven's sake. Here we go. Then there's AdTech. AppLovin helps mobile game developers grow and monetize their franchises, and its stock is up almost 90% this month. Viant Technologies has software that for programmatic advertising purchases, it's up 60%. Programmatic advertising, people love that. But let's focus on AppLovin for a second, because this is a great case study of what we're really seeing. This one was already hot before November. It's up now 700% year to date. Now, AppLovin's a fine enough company. They're solidly profitable. They reported a strong quarter this month. But was it strong enough to send the stock up 72% over the course of the next 2 days? At these levels, AppLovin is a $106 billion company, even though it's only generated a little more than $4 billion in sales over the past 12 months. To me, that's excessive. Maybe that's all it is. Maybe it's just excessive. What are other areas that have me worried? On Friday night, we started this discussion of excess in certain pockets with Rocket Lab USA. That's a space-focused company, the stock that's up 117% for November at the time. When we ran our screen this weekend, we found several other space stocks that have screened higher in November. There's Intuitive Machines, which makes equipment for space exploration, including some of NASA's recent lunar missions, and that was up 88% in November. Redwire says that it has, quote, valuable IP for solar power generation and in-space 3D printing and manufacturing, end quote. Its stock has run 79%. Globalstar offers low Earth orbit satellite-based communications, just like Starlink. It's up 78%. Planet Labs, it does satellite imaging and data insight services. That stock's up 71%. The strength in space stocks has extended to some other adjacent markets, like drones and electrical vertical takeoff landing plays. Red Cat. Okay, Red Cat's a drone maker, and its stock has more than tripled month to date. Archer Aviation is one of the two best-known electric vertical takeoff names. It's jumped 137% for November. Are these moves excessive? The potential for the space industry does feel limitless, and these stocks have scarcity value in the absence of a publicly traded SpaceX. But at the end of the day, this seems like irrational exuberance to me. Not a single one of those space stocks is expected to make money this year. Maybe they were all too cheap in the previous month. I don't know. We've seen some alternative energy plays pop onto the list, even though that's not exactly a priority for the incoming administration. Hey, hasn't stopped Bloom Energy, a barely profitable hydrogen energy play, from rallying 170% this month, mostly thanks to a deal with Cramer Faith, American Electric Power, to provide energy for data centers. That's a great win for Bloom Energy, but it doesn't justify the company going from $2.2 billion in market cap to almost $6 billion. Hey, speaking of energy, the nuclear power complex keeps roaring, especially the smaller, riskier, deeply unprofitable names. Nano-nuclear energy, NuScale Power. They both fell below the 50% mark today, but they've been up more than 60% as of Friday's close. There's Hyliion Holdings with a nearly 60% gain. That was the product of a SPAC boom 4 years ago. Originally, it was working on a hydrogen engine for trucks. Now it's pivoted to making more sustainable generators. No profits, de minimis of revenue. No thank you. Finally, some Chinese companies are starting to pop up on our radar. While most Chinese stocks are down, which makes sense given President-elect Trump's attitude toward the People's Republic, some specific stocks, well, they've soared. Near the top of the list is Kingsoft Cloud Holdings. That's a Chinese cloud software provider with a 152% gain for the month. There's another company called Yuxin, that's UXIN. Basically, it's the Chinese Carvana that we would have included before it fell 20% today. Kango, a company that appears to have just pivoted from used cars to cryptocurrency mining, is up 62%. Hey, by the way, I'm incredibly skeptical of any company that totally transforms its business model overnight. Regular viewers know that I'm not really much of a fan of the Chinese stocks, aside from the true heavy hitters like Alibaba. But I bring these speculative ones up because this week we get the second largest Chinese IPO of the year, when Pony AI comes public. Now, this is an autonomous driving play that's seeking a $4.55 billion valuation. The company raised the number of shares it's offered last week amid rumors that Uber would be buying into the deal. I've got no edge on Pony AI, but I'll just note that Zeekr, the largest Chinese IPO of the year, hasn't done much. It's up about $2 from its May 2024 offer price of $21 for less than a 10% gain. The S&P's up nearly 15% over the same period. You want autonomous driving? I'd stick with the much easier to follow and close to home Tesla, which I like very much. You want Pony? I happen to like, and this is my own analysis, I like Pink Pony Club. And I saw Chappell Roan at the Saturday Night Live, which is worth a lot more than most of the companies I've now described. Bottom line, when we come back after the break, I'll cover the final group of November red hots. You probably want to write them down. The Trump trades. Those are harder to figure out because the companies in question should genuinely benefit from the new administration, even if their gains are excessive. Maybe it's justified excess. So stick around for the next store of bilge, please. Hey, how about we go to Grant, New York? Grant.
Good afternoon, King Cramer.
All right. How are you, Grant?
I'm doing well, thank you. I just wanted to first and foremost say it's an honor and privilege to speak with you, my friend. Thanksgiving has come early. You've made my family and I a fortune of money, and you've kept us entertained for 19 plus years.
Thank you, Grant. That's very kind of you. I wish your family happy Thanksgiving, and you too. How can I help?
Well, thank you. I thought my thesis was that Taiwan Semiconductor would benefit from the AI revolution, but I'm in the house of pain. What do you think? Buy, hold, or sell? Okay,
now see, here's the problem. Taiwan Semi was up at 95, and now it's 185. It was at 95 last year, almost this exact week. So to criticize a company that's doubled up is really, really hard. Grant, I understand how you feel. I think Taiwan Semi is a great company. I would just hold on to it. Now, we're seeing areas of speculative excess all over this market, and it does make me, look, I'm nervous. That's why I'm doing these pieces. I think it could be an opportunity to take some profits where you can, and then if they come down, you're fine. That's all I'm looking for. Much more made money, including my final look at where excess could be popping up with Trump policy winners. Then, how should the Fed be shaping your moves in this market? I'm breaking down the don't fight the Fed mentally. And all your calls rapid fire to tonight's edition of the Lightning Round. So stay with Cramer. Tonight, I devoted half the show to calling out some areas of excess in the market, areas of irrational exuberance that concern me. We've seen multiple groups make extreme moves to the upside. Quantum computing, anything with AI in its name, some parts of enterprise software, fintech, insurtech, ad tech, not to mention the space stocks, a few alternative energy plays, a handful of speculative Chinese stocks, on and on. But there's a couple more groups that have had huge gains this month. It's just that those gains are maybe much easier to justify. I'm talking about the Trump trades, companies that should benefit enormously from Republican trifecta in Washington. For example, the two big private prison operators, Geo Group and Core Civic, have rallied 85 and 59% respectively since the beginning of November. These tend to be winners whenever the GOP is in power, but they're rallying particularly hard this time because Trump ran on an agenda of mass deportations. Keep in mind, though, Geo Group and Core Civic roared from the 2016 election to Trump's inauguration day in January 2017, but then they spent most of the next 4 years going lower. My view, legitimate thesis here, but the gains are so extreme that I worry they're running out of upside. Legitimate. Another example, a handful of smallish oil service stocks have popped this month. Now, one of the few things that we know for certain about President-elect Trump's economic agenda is that he wants our country to produce even more oil than it's doing. His new pick for Treasury Secretary, that's Scott Besson, has advocated for the country to produce an incremental 3 million barrels of oil per day, as I said at the top of the show. And his proposed energy secretary feels like an oil exec from the 1980s. The drill baby drill agenda is fairly obvious good news for the oil service plays. The companies involved in getting the resources out of the ground, even if it might hurt, because the producers will be putting a lot of downward pressure on oil and gas prices. By the way, that's what happened in 2016. The big three oil service names, SLB, Halliburton, and Baker Hughes, are all up big for November, meaning some smaller operators came out of nowhere and landed on our list of the market's hottest stocks. Solaris Energy Infrastructure specializes in distributed power generation systems and managing raw materials used in oil and natural gas wells. Its seeded stock jumped 73%. Aris Water Solutions offers water management, recycling, and supply solutions to frackers in the Permian Basin. It's up more than 63%. In November, Chart Industries makes highly engineered equipment used in the energy production process, and it's run up 57%. That's a stock we used to recommend all the time when we first started the show. Once again, big moves there. I can't say they're unreasonable. These are three very profitable businesses. Reasonable valuations. They're about to face a much more benign regulatory environment. What else? Oh, here's a tough one. Fannie Mae and Freddie Mac, two government-sponsored enterprises that prop up the mortgage market, have seen their stocks more than double on hopes that Trump will recapitalize and release these companies. I don't know if you remember them from the from the Great Recession. Oh, boy, they were front and center. I don't want to get too deep in the weeds on this tonight because it's a complicated situation. But in general, it makes sense for Fannie and Freddie to rally on this Republican sweep. There are plenty of one-off Trump trades, too, like Tesla, which is up 35% for November. This is all thanks to CEO Elon Musk's special relationship with President-elect. Of course, if Musk starts getting on Trump's nerves, well, you can see a serious pullback. But you know what? I'd be a buyer on weakness, though, because I'm a believer in Musk's leadership. How about Natural Grocers by Vitamin Cottage, which is up more than 71% for the month? This stock, which I've never heard of, is presumably rallying on the appointment of RFK Jr., a.k.a. Bobby Jr., as Secretary of Health and Human Services. He's got some nutty views on vaccines, a little critical of Big Pharma there, but he's also a health food nut. Still, that 71% run in a little-known natural grocer, I'm calling excessive. Cramer faves Sprouts Family Markets has only run up 15% month-to-date, and it's part of the same theme. Then again, Sprouts was already doing great on its own before the election because it's a really high-quality operator that I like very much. Finally, there's the big one, and you know what that is. That's Bitcoin. Bitcoin itself has climbed from just under 70,000 as of election night to just a shade under 100,000 on Friday before pulling back to below 95,000 today. Now, that rally has taken up practically the whole cryptocurrency ecosystem. Mara Holdings, not related to the one that gave away Saquon Barkley, that's run up 57%. Coinbase is up 74%, and, of course, MicroStrategy, a former software company that's now pretty much a leveraged Bitcoin fund, is shot up 65%. Obviously, the gains in crypto, especially the Bitcoin ecosystem, seem excessive. But, again, they aren't without reason. We're going from a Biden regime that was pretty antagonistic towards crypto to a second Trump administration that promised to be incredibly crypto-friendly. What should that be worth to the Bitcoin-related stocks? Well, we are going from a paternalistic government, which has tried to rein in the excess of crypto, to one that actively supports Bitcoin, although the other forms of crypto seem to have been left aside. When a president talks about a strategic Bitcoin preserve, you are going to see hoarding of Bitcoin, and it's going to work in favor of the holders, or at least the hodlers, as they call themselves. Plus, let's accept the owning actual Bitcoin or an ETF that tracks it as a nice hedge against our government turning on the printing presses to paper over the deficit. So call me in favor of owning Bitcoin. And also, by the way, buying some Ethereum, which I own, has fallen badly behind Bitcoin. I'm a believer. But these are hedges to me. And if you're hoarding crypto, be ready for the breakdown no one thinks can come. So what's the takeaway from all these excessive moves that I've been following? First, I certainly don't love seeing so much excess in the market. I did my best tonight not to get too specific with any one of these red hots. Some of their gains may well be justified. Most, I suspect, though, probably not. That said, I'm not trying to separate the wheat from the chaff tonight. I just want you to know that there's an insane amount of undisciplined buying in this market from people who seem to have no sensitivity to prices or valuation. And that does concern me. It makes me think that we could be closer to a top, at least in this kind of company, even if it's just a short-term top. than we are to the beginning of this move. Then again, I don't want to come off as a scold. I don't want to be a scold. I'm generally pretty encouraging in speculation. I'm probably the only person on TV who is. I'm in favor of it, but you got to be smart about it. And you only do it with money, say, let's let 20% of your individual stock money. No more than that, please. However, when you have so many enormous gains, you can't just keep going all in. You have to ring the register and take something off the table. That's prudent speculation, and call me a prudent speculator. So here's the bottom line. As I see it, with a nod to the holiday week that's just begun, if you had the good fortune to participate in some of these seemingly excessive moves, I think you should give thanks to your gains. And that means taking some profits if you're sitting on huge win, especially anything like a double or a triple in just over 3 weeks' time. It doesn't mean you have to sell your entire position. Not at all. You can keep some on. But trust me when I say these types of runs are highly unusual, and they do tend to fizzle out eventually. So take what's been given to you, give thanks for your gains, and make sure you're not letting wins turn into losses. Do it for me. We will all feel better with some money in the bank. If you can take out your cost basis, do so. And then you can let the rest run. You'll never turn a profit into a loss that way if you take the initial capital off the table. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's over the lightning round. Question is right. For cold numbers, savings, sales, buy, sell, sell, little cost, stock, question. You'll play this out. And then the lightning round is over. Are you ready? Ski Dad. Time for the lightning round. Let's start with Brian in Rhode Island. Brian.
Hey, Jim. You know, I realized today I've been watching you for half of my life, 19 years. I love the show. I love how you're straight to the point. No sugarcoating. Beautiful thing. I'm calling
I hope I don't let you down. I hope I don't let you down. SYM? Okay.
Symbiotic,
SYM is, look, this is AI robotics. This is a very hot sector. The good news here, this company does make money, and so therefore I am going to bless it as a buy. Let's go to Steve in Colorado. Steve.
Booyah, Jim.
Go for it. What's up?
Hey, I'm doing great. Thank you so much for taking my call, and thank you so much for helping all of us small investors over the years.
Wow, I'm a small investor too. How can I help?
Hey, I want to give a big shout out to my sister-in-law, Susanna, in Escondido, California. She turned me on to this show in 2007. She said it was by a crazy guy who talks stocks all the time. And
well, there you go.
I've been a faithful listener. And
well, tell Savannah, thank
years.
you. Well, there you go. Thank you very much. Let's make some money together right now, right here.
Hey, I've owned this stock I want to talk about for many years. It's made me a lot of money. I've owned it since 2007. And I actually sold out my position a few months ago. I'm getting older and was looking for dividend stocks. But I noticed that this stock went down 22% overnight, and I listened to the conference call like you advised us to do.
Right.
And is Tetra Tech a casualty of the new administration's?
Tetra Tech is a very, very good company that is lucrative, that does management consulting, and yes, it reported a kind of weak quarter at the exact same time that Doge, that Musk and Ramaswamy took aim at companies like this. That's what happened. I want to thank you for the kind comments, but I will also tell you, I didn't think the quarter was that bad. I actually am inclined to buy, not sell, TTEK. Let's go to Joe in Virginia. Joe.
Hello, Jim. Thanks for taking my call from Virginia's second largest city, Chesapeake. I have held Lindy, PLC, stock symbol LIN, since it was Praxair, with all dividends reinvested. What is your highly respected opinion of this stock?
Okay, my Chapel Trust owns it. It's at $455. It would not surprise me. We had the company on recently. It would not surprise me if that stock's to go to $500. It is not a speculative stock. It is a very good company, and that actually is held against it. Very good company, should not be left by the wayside. Lindy is a terrific company. How about we go to Jim in Washington? Jim.
Dr. Cramer, thank you for taking my call. Thank you for making my day. Thank you for all the help.
I'll do my best.
I'm a long-time listener, first-time caller, Charter Club member, and I want you to know I'm wearing a T-shirt my wife bought me many years ago that says, "Booyah, Ski Daddy, are you ready to make some mad money?"
Oh, man, a vintage eBay. Definitely. What's up?
My question is Brookfield Corporation, BN.
Okay, this stock has been pretty much straight up, and you know what? It's not done. This is a very smart asset management company. I am actually jealous of how smart they are and how little publicity they get. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
You may be sick and tired of hearing it, but it needs to be said. When the Fed gives you a rate-cutting cycle, you have to suspend your critical faculties, hold your nose, and just buy. The Fed is your friend right now, and trusting your friends is a good bet, as we've seen over and over again. Consider the case of Home Depot. When it reported the quarter was okay, nothing to write home about, filled with negative same-store sales numbers, both future and past. The despot reported when long-term interest rates looked like they were headed higher, maybe much higher. 10-year traveling from 4.5 from 4.3 just a couple of weeks ago. Even though the Fed was cutting rates, it looked like it wasn't having much of an impact on the stock market. I had faith that long rates would come back down like they did today, but only because I learned from the best. When I first really got into investing in law school, I'd watch Wall Street Week, this fabulous Friday night show on PBS, hosted by Lou Rukeyser. Time would just stop for me. Let everyone else go blow some steam off. I didn't care. I'd sit back in front of my little black and white TV and I'd learn. Each week, Lou would have a special guest, often a person who was from Wall Street who knew a great deal about a group of stocks, which I later learned were people from research departments in the strange world of brokerages. The real star, though? Oh, that was easy. It was always Marty Zweig, this incredibly understated money manager and professor, who, when he spoke, even as a panelist, ever so briefly, well, I would scream at anyone saying, "Shut the heck up, Marty's talking." I love Marty's simplicity. There was don't fight the tape, which I would still distill into something like when stocks are going higher, buy them, and when stocks are going lower, sell them. And then there was the don't fight the Fed. Now, this was a phrase that totally mystified me. How could you fight the Fed? I mean, how could you befriend the Fed? What does it mean to be the Fed's bud? The answer, it means that when the Fed's trying to reignite the economy, you need to get on board. You had to find stocks to buy and buy now, even if you didn't like them. You had to be thinking of the future. Marty, who passed away a long time ago, would tell you that near-term gyrations do not count. If longer-term rates went higher as the Fed started cutting rates, like they did this time, he'd say that couldn't last. The Fed's just too powerful, even more powerful than the bond market. So if you get a chance to do some buying because things seem weaker, you have to hold your nose and pull the trigger. Don't be misled by the action. Just trust your buddy pal friend, the Federal Reserve. Now, we've been buying Home Depot for the Travel Trust when it reported, and sellers amassed their stocks, and they just kept hitting any bids that there was. Sell. Including mine. I didn't care because I was armed with the market history that suffused the thinking of Marty Zweig. The well-informed mantra, don't fight the tape and don't fight the Fed, gives you the confidence to buy when everyone else is selling. When you get lower short-term rates, that leads to a lot of home equity loans to repair and remodel. You get cuts in short rates, you will ultimately see longer rates coming down too. So it doesn't matter what Home Depot says. It only matters what the Fed does. And that's how you get this terrific run in the stock, including today, by the way, when the stock rallied $8 and change and at one point hit a new high. And that's how you get a Florida Stanley Black & Decker, a company we interviewed just this week where management wasn't all that bullish about business until 2027. But the stock's been running big since then. Why? Because the Fed can't be beat. Now, some of these gains also came because the Treasury Secretary designate did talk about gradually phasing in tariffs, which could give both companies more time to adapt to what will be a costly adjustment. But what really matters is that when the Fed wants the housing market to come back to life, we have the least turnover in 30 years. It's coming back to life, whether it wants to or not. Something for all of you bears out there to think about. I'd like to say there's always a bull market somewhere. I promise I'll have just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.